Welcome to Markets in a Minute. My name is Austin Duke. I'm financial advisor and chief investment officer for Diamondback Financial Services. We are an investment advisory firm focusing on clients who recognize the need for solid investment advice, who don't want to invest on their own, but still want to be educated through the process. This is the Monday, November 24th, 2025 edition. Let's get started. Investment values fluctuate on a daily basis for a variety of reasons, and our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. Diamondback Financial is a long-only investment firm, which means we try to keep your money invested at all times in areas we feel offer the best prospects for growth, and instead of trying to time the market per se. We focus heavily on the traditional investments of stocks and bonds, so we analyze fluctuations in the stock market and interest rates to help drive our investment decisions. So we'll start with the stock market as measured by the S&P 500. This is an index of the 500 largest companies in America. And over the past 2 weeks, we saw the stock market decline about 1.87%, but that still leaves us with a year-to-date gain of 12.26%. If we move on to interest rates, these are measured by bonds issued through the U.S. Treasury Department. We believe that interest rates are the preeminent measure of investment risk, and rates are factored into every investment valuation calculation, including stock valuations. And generally speaking, lower interest rates will lead to higher stock prices, and higher interest rates lead to lower stock prices. We pulled up what interest rates have looked like over the last month. The solid green line is where we are as of Friday, November 21st. The dotted green line is where we were 2 weeks ago, and the brown line is where we were a month ago. We've got interest rates listed over here on the left-hand side. We got duration for the bond maturity listed on the bottom from 1 month all the way out to 30 years. And each of these dots represents an interest rate for a given maturity length. So we've seen interest rates come down on the short end here of a year or less maturity. And then we've seen rates actually drift higher on the medium and long-term end over the past month. But I mean, really, really small changes in interest rates over the past month. Nothing really that we're overly concerned with at this point. For our recent developments portion, I just wanted to take a step back. We've got a chart of the stock market here that's from not inauguration day, election day last year through Friday. We can see a little bit of an increase in the stock market after President Trump got reelected. Not a whole lot of action for the first couple months after that. This is when he makes the announcement that we're going to start adding or modifying the tariffs on Canada and Mexico, and other tariff announcements will be coming. And Liberation Day here at the beginning of April, with the significant drop that we had in the stock market. If we looked at the highest trading position within a trading session here in February, as well as the bottom in April, we actually had a 20% decline in the market on an intraday basis. But historically, we use the closing of each market day to measure how far the drop was. So we officially only get an 18.9% drop, but we did encompass a 20% drop, including those other highs and lows. We had a little bit of a recovery, almost a 10% recovery from that bottom once we delayed the tariffs. We did have another quick 5% drop in April after that. But really, it's been pretty steady as she goes. It's been off to the races for the last 7 months. And we did get a little blip here when President Trump had a meeting with China and flirted with the idea of calling that off and modifying the tariff negotiations with them. But we really haven't seen anything throw a wrench in the market activity for the majority of this year until the Federal Reserve met for their meeting on October 29th, and they cut rates, but gave a very stern rebuke to the markets and said, hey, nothing is guaranteed. We are going to take every meeting one by one. There's no expectation that we're going to cut rates again in December. And we've just seen the market kind of adjust to that news. We've officially had another 5% decline here in November since that meeting. We did have a recovery though on Friday, which is helpful, and we'll get to that in a minute. But again, we try to educate our clients and let them know that the 5% declines will occur 3 times within a 12-month period. Every year, one of those will extend to 10% or more, and every 3 years we'll get a decline of 20% or more. So there's always a reason for it, but we kind of get used to 7 months of positive returns. And when we hit another 5% drop, it's sometimes a little bit painful to live through, but these are things that happen, and there's always a reason for it, and we can get through it. And whether or not this turns into a 10% decline or not, I've got my opinions, but this is normal stock market behavior, so it's not something that we necessarily need to get super concerned about. I wanted to step into interest rate probability or interest rate cuts, the probability that we'll get a cut. If we go back to October 28th, the day before the Federal Reserve cut rates, we had basically a 100% probability that they were going to cut the next day, and about a 92% probability that they were going to cut again in December. So we have the meeting, and immediately after, we adjust those rates or those probabilities of rate cut down to 69%, right? That's a pretty significant drop in that probability. Those probabilities continue to decline. It bottomed out here on the 19th of November at about a 29% probability. And then we've had a couple of the voting members from the Federal Reserve Board speak over the last couple of days, and we've had a massive shift higher that we're now expecting more likely than not to see an interest rate cut, which we think also helped lead to the stock market recovering on Friday, which was really broad-based. This is the individual components of the stock market and some of the performance that they saw from October 29th when the Federal Reserve had their meeting until we got that 5% decline here just a couple days ago. The companies, the names that we know have been driving the market higher, the Magnificent Seven, as we've called them, NVIDIA, Microsoft, Meta, Tesla, these have all seen double-digit declines, and some of them, more than 20% declines in what, 3 weeks or less. So it's concerning to say the least, but we know that there are several reasons that we can think of that where the news has been all over it, trying to let us know that there's a potential for a decline in these individual names. We mentioned a couple weeks ago people coming on the news and saying, "Hey, we kind of expect we'll see a 10% decline over the next 10 to 20, 12 to 24 months," or we think companies like NVIDIA are trading too high and we think they're going to come down. And we said that these guys probably had investments that would profit from a decline in these individual names or in the market. And they were coming on hoping that what they said would come to pass and they'd make some money on it. What was interesting, so NVIDIA reported earnings on Wednesday after the market closed. On Thursday, the market opened up higher by 1.5%. I think NVIDIA was up 5% at the open. And then around 9 o'clock Mountain Time, something changed, and we had a significant sell-off in the market and NVIDIA. By the end of the day, I think NVIDIA was down 3%, and the market was down 1.5%. Friday morning, Bloomberg told me that that kind of a market activity has only happened 4 times in history, and I don't prefer making history in that way. I'd rather it be the other way around, that it start lower and end higher. But obviously something happened, right? We don't see a company the size of NVIDIA move 8% like that without something happening behind the scenes, and nobody's been able to report on it yet. My opinion, my theory is that these people who are managing money, a lot of money, had these investments in place, and if the stock goes higher, then their investments lose money, and so they probably were saving more billions as a hedge in the event that NVIDIA did beat on their earnings expectations and that their stock was up, so that they could then pull the trigger on additional investments to lead that stock price lower, right? A lot of egos, a lot of alpha males, a lot of pride in Wall Street and people not wanting to lose money, especially when we're talking about billions of dollars. So, um, and that's just my theory is that we had more people trying to push that stock and the market lower, so they could profit on their positions. Something else, obviously, these are technology companies and they are sensitive to interest rates. And if we think interest rates are going down, then we think that their cost of operations is going to improve. If interest rates are going to stay the same or go higher, then their cost of operations will potentially go higher, or the valuation that we have for their stock price may not reflect higher interest rates or flat interest rates. So that can also help explain why some of these companies have had a rough couple of weeks. The other thing, so we've been hearing a lot on the financial news media that there's what they call circular financing, where we've got NVIDIA, these Magnificent Seven names, AI related companies that are all making announcements about investing in each other. And I think part of that has to do with tax incentives that came out in that big, beautiful bill act that Congress signed earlier, or Congress passed earlier this year. And but they still have to find a way to finance those commitments. So it's either going to be cash that they already have on hand on the balance sheet, or it's going to be cash generated through operations, or it's going to be debt financing. And regardless of which of those methods that you're using, it's going to change the ratios on your financial statements and the calculations, and whether or not analysts are going to believe that the stock price is worth whatever it is, or what changes they need to make to their expectations. So one company that we heard of that we saw on Bloomberg was Oracle. Oracle had a pretty rough couple of weeks. Oracle's down almost 25% over the last 3 weeks. And Oracle has made a very large commitment of investing in AI related companies. They've announced that they're going to use debt financing to make that commitment. And in the investment world, we have what's called a credit default swap, the CDS. It's basically an insurance policy that will pay out if Oracle defaults on their debt. And this chart is showing the cost of that insurance in this white line, and it's gone up significantly over the past couple of months, which is basically to say that people who are buying this insurance are paying more money because they anticipate Oracle is going to default on their debt. So there's a lot of people making commitments, investing a lot of money, billions and billions of dollars, tens of billions, hundreds of billions in this AI race. And as long as everything works out, then we're fine, and the stock prices can continue to go up. But there are so many things that could go wrong, and it wouldn't have to be all of them. One of them could break. Somebody like an Oracle defaulting on an obligation could be enough to send their stock price down, which right now they haven't defaulted, but it's the prospect of them potentially defaulting that is partially to explain or to blame for the drop that they've seen over the past couple of weeks. Finally, just wanted to say this chart is the stock market, the S&P 500 here in the white line. This is again October 29th when the Fed had their meeting and cut interest rates to Friday. This blue line is the equal weighted S&P 500. We've been talking a little bit about moving out of the market cap weighted into an equal weighted type investment. And this is just for observational purposes. Again, this is not an investment recommendation, but we've been discussing that this is something that we're considering because we've got the top 10 companies in the stock market in the market cap weighted S&P 500 that make up 40% of the entire index. The equal weight gives an equal weighting to all 500 companies, so it's less sensitive to those top heavy names. And this is just showing that the equal weight has, for the last few weeks, outperformed. It's still down. It's still lower than it was when it started out on October 29th, but we can see that it's done a little bit better because it hasn't been pulled down as far by those top 10 companies in the market. And even then, on Friday, you can see the slope of this line is sharper to the upside than the market cap weighted, because 90% of the companies in the S&P 500 were positive on Friday, with the concept or the expectation or hope, the re-rating of an interest rate cut that we're hoping for here in December. It was a very broad-based recovery, so we saw a better performance coming out of the equal weighted index. All right, that was a lot of talking. Getting into the expectations, implications portion. This week is Thanksgiving. It's a holiday shortened week for the markets, and people are usually out of the office. So there's not a lot of trading, and we don't take a lot of stock in the movements that we see the week of Thanksgiving. But what we'll be looking for is the week after. The first 2 weeks of December, we'll be getting ideas about Black Friday, Small Business Saturday, Cyber Monday sales that first week of December, and seeing, is the consumer still healthy? Is the consumer coming out and spending money now that the government shutdown's behind us? And now maybe that companies that built up inventory pre-tariff announcements are now going to be offering better discounts than they otherwise would have. So we'll be looking at those numbers to see what the consumer looks like. And we'll be looking for whether or not the Federal Reserve cuts rates on December 10th. We think those two items are going to drive what the market does for the month of December. If the consumer doesn't look so good, we don't get an interest rate cut, we would expect December to be flat or negative. If we do get an interest rate cut and the consumer does come out and spend and things look good, then we would expect to have our Santa Claus rally and have a positive December. So that's kind of our expectation there. But as a final word, it's Thanksgiving. We're grateful for all of you guys. We're grateful that we're still in this business and get to do this every day, and get to work with you guys. So we appreciate you. Hope you guys have a great time with family and friends this holiday season. We're officially out of the office Wednesday through Friday, but we're not traveling, so we'll be available if you need something. And other than that, have a good week, and we'll see you soon.